Making extra payments towards your principal balance on your mortgage loan can help you save money on interest and pay off your loan faster. But before you decide to use an inheritance or your savings to pay off your mortgage, or even before you decide to make extra payments, it's important to take a step back and determine whether it really makes sense, financial sense for you. In this episode, we discuss a hotly debated topic among US homeowners, whether or not to pay off your mortgage early. If you're interested in this type of content, please subscribe. It helps us grow and sustain our ability to inform and educate a larger audience. Now, this is the Beyond Return Show, a forum about business, markets, financial planning, and more. We are here with Montebello Avenue founder Robinson Crawford. Robinson is a certified financial planner who serves over 50 clients locally and throughout the country. Robinson is in Phoenix, Arizona. My name is Gabriel Kaplan, and I'm the founder of Wealth Habits and Strategic Investors. I'm a financial advisor, and I help people invest and manage portfolios for them. Given my background as a CPA, I also happen to help clients figure out strategies to optimize their taxes. So for today's agenda, we have the topic of whether or not you should repay your mortgage early. Then we're going to discuss tax location. In other words, it's also called asset location. The last topic on the agenda for today is, what are you most looking forward to doing when things are back to normal? Let's start. Should I repay my mortgage early? What are your thoughts about this?
This is a more complicated question than people give it credit for. I think that there is the possibility of over-analysis here. You can really get analysis paralysis and get too far into it. I would start by noting that in the recent book that came out by Morgan Housel, are you familiar? Psychology of Money, I believe it's called.
Oh, yeah. It's one of the best sellers, right?
Definitely. I recommend it to absolutely everyone. It's an awesome book. He notes in there, I think the last chapter is what he does with his money personally. And he understands that it may not be the financially optimal move, but he has worked towards paying off his mortgage early as just a personal choice. And that's a really smart guy.
Yeah, there's no right answer, or there's no single answer that's right for everybody. It really depends, on your particular situation. I think the biggest consideration people should start off with is, if you're thinking about it on an economical and a financial perspective, I think it's an opportunity cost question. So whether you want to pay off the mortgage and you get some savings there, versus if you could, use that cash that you're going to pay off the mortgage for and invest it in the market or whatever you want to invest it in. And the question is, where do you get the best return? And so I think there's that aspect, the numerical aspect, for people who are interested in the financial answer to that. I think you have to know. I think it's like interest rates. Is what is the first step, right? You want to compare interest rate of your loan versus whatever you get in the market, but also what's your effective tax rate? Because for some people that matters in terms of the mortgage interest for some people is deductible, right? If they itemize. How would you go about this?
I want to ask you if you think my thinking here is correct on this. So the way I like to frame this mortgage interest deductibility piece to make it just a little bit easier, because when you think about, oh, I want a mortgage because I want to pay interest because I want the deduction, there's a little bit of circular thing going on there that doesn't make a ton of sense. Interest is an expense that you either pay or don't have to pay, right? I don't recommend going and getting a mortgage just to get the deduction. That's not, I think, economically sensible. I like to think of mortgage interest, if you're going to itemize, which we can get into where that applies. I like to think of it as just a reduction in the actual interest cost. So you can look at a 4% mortgage and say, all right, I'm getting a deduction on this interest. Therefore, it's effectively closer to maybe a 3.25% interest loan if this were a personal loan and not a mortgage.
The mortgage is there typically because you don't have the cash, or if you don't want to use a large amount of cash to pay down a house. Again, it all comes back to the opportunity cost. Like, what is the best use of your capital to fulfill your life goals? For some people, I would say at the end of the day, they want to feel better psychologically, and they will repay down the mortgage. But for some other people who can actually, um, you know, would prefer to invest the money in the market and get a higher return, they won't. I think that is the end of it. Most people, when they're about to retire, my experience is that they don't want to have a mortgage. They want to be able to retire mortgage free. The problem is, or it's a good problem to have. The interest rates are so low now that it kind of doesn't really matter so much for some people.
That's a hard thing to convince people of if you're outside the business where you're looking at financial models of people's future, right? And you're like, okay, well, if we keep this invested versus, selling some of your investments and paying off the mortgage, in my experience, it's a little bit of a hard sell to say it doesn't matter. It feels like it matters in my experience, right? People really think it does. But the reality is exactly what you said. It's opportunity cost, right? Do we feel better about owning this investment or having no mortgage? The psychological element of that cannot be understated, cannot be overstated. It's tremendously important.
So I want to go through an example. Let's say, like, how would you go about calculating the from a numerical aspect? Let's say I itemize my taxes, right? And I have a fixed mortgage of, let's say, 400,000 at a 3.5% interest rate, and my combined federal state income tax, the effect. So the marginal, you use the marginal rate, right, to calculate this. So then my income tax rate is like 30%. So essentially, if I backtrack there, my effective mortgage interest rate is like only 2.45%. And you look back at the market for the last, I don't know, was it 30 years, 40 years in the S&P 500, and the performance has been between 9 and 10%, depending where the cutoff in the beginning is. Um, it's how do you go about telling a client, or like explaining that differential, and like this is the economical.
The juxtaposition I like to make is that the interest on any of these loans that you're going to hold, whether it's a mortgage or a car loan or whatever it is, that much is guaranteed. It's a guaranteed rate of return, right? A guaranteed negative rate of return on your money of this much percent in your example, 2.4-ish%, right? That much we know. I think it is ultimately viable to do that comparison of maybe a historical back test, and maybe um, I would encourage people to take either work with a financial professional who can help you weigh this, or take some sort of haircut against the past that's a reasonable number. So if the S&P gave you 10% over a long time period, maybe cut that by 30 or 40%, and understand that you're still going to pay that volatility tax, right? You're not going to make 10% every year, but as a patient investor, you can reasonably expect maybe 5 or 6% on that. So that if you take those things and you model them out, it's going to look better for the investments every time, right? Even with volatility, which is one of the reasons why the choice to pay down the mortgage is maybe on paper suboptimal, right? To go back to what we said at the beginning, but not necessarily psychologically suboptimal. Or
Well, that volatility has a value, right? Like a negative value. I'm saying, like, higher volatility is worse for your emotions. Maybe your health even. So the question is, like, what is that for each client, and for each client that utility will be different. And I think that's, at the end of the day, the bottom line, right? What works for the X person will now work for the other person.
That's right. That's right. I would also consider going down the risk spectrum and look at what you can get on the other side. So if you go and buy treasury bonds, or if you go and buy mortgage bonds, how does your after tax return on something like that compare to the mortgage? That makes it a little tougher, and a little maybe closer to saying, yeah, I'd rather keep this really cheap mortgage than go and earn low returns on fixed income assets, for example.
Yeah, I mean, I would tend to try to look at municipal bonds, because that avoids the tax question. So you don't have to do the tax equalization. It's easier to explain to people, right? So if you live in, I would say, New York City, you would look at a mutual fund of New York City tax exempt bonds. And you can look at the yield, what's giving you, and you compare that to the interest rate. And I think um, Is that a fair comparison? Would you use that maybe?
I think that is fair. I'm a little biased specifically against New York City municipals. I think the credit risk associated with that. So for the sake of someone who's maybe not super versed in this, I would try to minimize credit risk and use treasury bonds.
I think the next topic that's on the agenda is tax location. Happy if you can take it off.
Yes, this is an under-discussed area of financial planning that I don't hear. I hear financial planners talking about, but I don't hear a lot of individual investors talking about this or optimizing for this. So it's a bit of an advanced topic, I would say. This is basically the breakdown in your own personal portfolio of in the US, it's functionally three buckets. One bucket is taxable, which is a regular brokerage account or joint account you have with your spouse, a trust account. The second bucket is pre-tax, which most people tend to allocate to in a traditional IRA or traditional 401k. In addition, your employer match will be in that pre-tax bucket. And the last bucket is Roth, which is tax-free growth. So these three buckets have different characteristics, different strategies apply and are optimal for each. But there's a lot of art and probably some science in figuring out where which assets should be located for your financial plan.
So let's say you're a young person, you're in your 30s, long stretch. You don't plan to retire into 30 more years. This is for retirement. Like all three accounts, you're maxing out of the 401k. You're doing a backdoor Roth IRA to fill up a little bit of the bucket of the Roth account, and you're saving a little bit more in a regular brokerage account. And you're saying like this pot is for retirement. Where would you put maybe fixed income?
That's a hard one. That's going to be very context dependent. So, for instance, if you have a short term goal and you say, look, in the next 5 to 8 years, I'm going to have this down payment on a house goal, fixed income can be appropriate in the taxable account, right? Even if you are at a high tax rate, it can still be practical to do that. Fixed income right now is an especially difficult one because it generates immediate taxable income for people who don't necessarily need that. For instance, if you have a high paying job, it's not optimal to generate more taxable income to you, right? That can be, if there was one summary headline thing for the tax location thing, it's that it's not to generate more income from your investments than you actually need, right? So all things equal, I think the answer is probably pre-tax,
Yeah.
the traditional IRA, because the Roth. I always say that the Roth is where you want to get your highest expected returns out of your Roth account.
There's one more thing, an element that I would ask, like if you had municipal bonds, which are tax free, where would be the best location to put those?
I feel like there's a joke meme about this with Tim Duncan joking about not having municipal bonds in an IRA, but municipal bonds do not belong in any retirement account whatsoever. It's a double tax avoidance thing. You are going to waste money by doing that. There should actually be tripwires, in my opinion, in brokerage accounts when people are about to buy municipal
Yeah.
bonds for an IRA or a Roth.
Yeah, it's like, are you sure you want to do this? It's already tax free.
Right. Right. So those only are for taxable situations.
Yeah, and there's you're paying. Let's say you get a yield penalty a little bit if you compare that to corporate bonds, right? Just because it's tax free. And so for some people, especially in the high tax brackets, it's usually favorable to buy municipal bonds. But if you're in a low tax bracket, municipal bonds probably isn't the best answer, right?
This is a lot of high school math. Get your tax bracket, look at the yield of a municipal bond mutual fund, look at the yield of a corporate bond mutual fund, and try to make those equal in terms of credit and duration. Could be tough, but do your best. Look at the yield of those, look at your tax rates, and say which one of these has a better expected after tax return.
Yeah, I would say that is traditional math, college, finance 101, that everybody should know. This like essential knowledge in order to compare investments.
Yes, I would tell people to consider the dividend. So if you're going to invest in a strategy that has dividends, there is a pretty big difference in the taxation of what's called qualified versus unqualified dividends. The easy way to think about this is that um, international stocks, if you own an international stock ETF, for example, and you receive dividends from that, that's going to be a non-qualified dividend. Whereas a U.S. S&P 500 ETF will generally pay qualified dividends, and they're taxed at different rates. The qualified dividends are much more tax preferred than non-qualified dividends.
In what instances would an international stock get qualified dividends?
I don't believe there is an instance. I think it's specific to U.S.
Yeah, I think
U.S.
the rule. I think you're
corporations.
right. I think the rule says it has to be a U.S. Well,
Mm-hmm.
does it have to be a U.S. in the U.S. exchange, or does not sure how that works though?
I'm not sure because there's plenty of U.S. companies that generate, enormous profits from overseas. But I know for a fact that if you own Apple stock, your Apple dividends are treated as qualified dividends. So
Qualified. If you hold it for I think it's like more than 60 or 120. I forget how many days, but
yeah,
there's a little.
it's a short holding period. Yeah, it's not for day traders, but if you're a buy and hold investor, you should get qualified dividend treatment for holding U.S. companies, but not REITs. That's another side one. So real estate investment trusts.
And then the last question we have for today is our post-COVID question. What are you looking forward to doing when things get back to normal?
A lot comes to mind. My first one is I will go see a movie almost right away. I've seen plenty of movies at home. It's not the same. I like movie theaters, like the experience. There's a few restaurants that just the vibe of the restaurant I really like. I haven't started going back regularly. Places that are small and crowded and cramped, right? That's just like how they work. I definitely miss that vibe. And we've started talking a little bit about travel for next year, what we want to do. I think we're going to do a Hawaii beach trip, and I'm looking forward to that being hopefully not with masks or a terrifying airport experience or all those other things. Those are my big three.
If a vaccine was offered in your near where you live, would you take it?
All things equal, I think I would. I don't know, but I tend to. I'm a product of modern science, right? I tend to. I don't mean to trust blindly, but
Have you talked to other people who said no, I'm not taking it?
I have heard that sentiment. I haven't heard it directly from people.
Yeah.
Of course, it's everyone's right individually to interpret the data and do with that what they will. But yeah, I think I'll be taking it.
It's tough. I feel like that's a very good risk tolerance question afterwards. Like, did you take the vaccine immediately? It's like, yes. Okay, you are in the bucket of risk for stocks.
Yes.
Did you wait? How long did you wait?
Right. What were
5
you looking
days?
for?
Okay. 5% fixed income.
That's pretty good. What are you looking forward to? What are you going to do post normalcy, whenever that is?
Flights, restaurants. I think the first thing is just figure out vacations. I can tell you one thing though, and I'm not alone in this, but I've consumed a lot of stuff. I have a lot of points on my credit cards, and they're like the balance has been growing and growing and growing, and we're looking forward to having free vacations.
I have a question for you I know we're planning to dive into this in a future episode, but do you plan, for instance, in November or December, are you planning your family's 2021 vacation budget and allocating that specifically, or is that not a level of granularity that you guys normally do?
Cash. We usually pay the tickets out of from our cash budget, and the reason is we usually travel in blackout dates, and so it's very difficult to get flights. I don't know how that will be this year. So that's mostly what we spend on. We don't spend on hotels usually. It's all points. And then we have a restaurant or activities budget. But yeah, we set the budget beforehand. But this year, I think it'll be messed up. Who knows how much we'll spend? I have to talk to my wife about that. But
consult your wife before setting an allocation for vacation budget.
There's, I think it's more the other way. Like your wife tells you, and you will say yes, And then you'll say that's not possible. But if it's possible, it's always a yes.
Yep. There you
She
go.
organizes the vacation though, so even though if I get, we allocate a certain amount, there's a low probability we'll hit that amount. It's always
Sure.
I,
Skewed slightly higher.
I have to account for like a 30% over budget.
Slippage.
Yeah. But yeah, that's all we have for today.
Excellent. Appreciate you having me on again.
Yeah, thank you. Anything that is said on this show is for educational and informational purposes only. It's not specific tax, financial, legal, or investment advice. Before acting on anything that is said here, please consult with your own accountant, attorney, or advisor.